I'm Anthony Smith, and you're watching the Chart of the Week. Hello and welcome to our weekly video. For my regular viewers, I'll bet you had more than a sneaking suspicion that this week's video would have something to do with inflation. Guilty. February's CPI is in, and it is ugly, up 7.9%. That marks the 10th straight month with CPI inflation of 5% or higher. Now, there are indeed multiple factors converging to give us the highest inflation we've had in 40 years. You've got labor shortages, you've got supply chain bottlenecks, you've got tremendous fiscal and monetary stimulus. And there's another factor that is going to be the focus of this week's video, deglobalization. Now, I struggled to find a chart to really capture deglobalization, so this is going to be more of a discussion-only video this week. So let's back it up. Before we touch on deglobalization, let's talk about globalization and what that means. And I think of globalization as a growing interdependence among countries and economies around the world, characterized by free trade, cooperation, and countries doing what they do best and exporting that to the world, and then importing what they don't do efficiently or effectively. And one way in which globalization has kept a lid on price inflation is through the offshoring of production to countries with cheap labor like China. And unfortunately, for the general level of prices, there has been a retreat or a reversal of globalization in recent years. And this was going on even before the pandemic. Just think of all those headlines about tariffs in the years leading up to the pandemic. What the pandemic did is to really supercharge the pullback in globalization. And so now we're seeing big pushes to buy American. We're seeing more tariff talk, and we're even seeing some companies moving production back to the U.S. in order to reduce the susceptibility to supply chain disruptions. And all three of these things put upward pressure on prices. So what I've found fascinating about just being an observer of financial markets, economics, politics, is how globalization has met or failed to meet the expectations of its supporters. So the dream of globalization is that increasingly linked economies and countries and freer trade would lead to a greater adoption of capitalism and democracy, and most importantly, fewer armed conflicts or wars. Take a look at the European Union, for example. It has the single currency, the euro. So Europe has had a very bloody past. And the supporters, or many of the supporters of the adoption of the euro as a single currency, they did this because they thought it would reinforce European unity and would lead to fewer or no wars. Sadly, war has broken out, but just east of the European Union nations, not in the European Union. And this overall is certainly working to reduce globalization. And it's unfortunate, but Russia has largely been shut out by the rest of the world as a result of its actions. And because Russia was integrated economically to some degree globally, the price that it's paying for its actions is quite steep, and it's steeper than it would have been if it were an entirely closed economy beforehand. So as you think about the various factors driving inflation, like supply chain bottlenecks and fiscal stimulus, you may find yourself wondering which of these factors is transitory and which of these factors may be more persistent in nature. And it seems like to me that deglobalization is something that has some staying power when it comes to placing upward pressure on prices. I don't think that that effect is going to fade anytime soon. So it certainly makes me hope that the other factors are more transitory in nature. That is it for now. Next week, you should expect the Fed to announce a quarter percentage point increase in its overnight rate to then target 25 to 50 basis points. This is a widely expected move, so I wouldn't expect any major market reactions one way or another in response to that announcement. Thanks again. We'll see you next week.